Hello, I'm Alice, your virtual drawback assistant. Today, we will be discussing the topic, what is duty drawback? Duty drawback is a trade refund program administered by U.S. Customs and Border Protection. It provides refunds of duties, fees, and taxes paid on imported merchandise that is later exported or destroyed. Established in 1789, it's the oldest trade refund program in U.S. history. Drawback is retroactive for 5 years from the date of importation. Often this creates a significant windfall of refund opportunities for first-time claimants. And it refunds 99% of duties, fees, and taxes, while customs keeps 1%. Here's an example. A company imports sunglasses into the United States and pays duties and fees to Customs and Border Protection. The company then consolidates the sunglasses in their warehouse. Some are sold in the United States, and others are sold to customers abroad and exported. The exported sunglasses are matched to earlier duty-paid imports, and a drawback claim is filed with Customs and Border Protection, allowing the company to receive refunds. Let's dig a little deeper into drawback. Next, we'll talk about matching methods. A drawback matching method is how a qualifying export is paired with a previous duty-paid import. There are 2 ways to do this: direct identification and HTS level substitution. First step is direct identification. The simplest way to think about it is matching imports to exports at the part, SKU, or material level. To compliantly use this method, Customs requires lot or serial number tracing. For example, a vehicle has a unique serial or VIN number. That number allows the import to be tracked into inventory, show being withdrawn from inventory, and then exported. The item maintains its identity throughout the process, and that's what we call explicit matching. But what about retail apparel? Clothing doesn't come with serial numbers. In cases like this, Customs allows companies to use a drawback accounting method. This is essentially a structured way of turning inventory for drawback purposes when lot or serial tracing isn't possible. The second matching method is HTS level substitution. With this method, duty-paid imports can be matched to qualifying exports that share the same 8 or 10-digit classification. That's right, we can ignore part numbers entirely. Domestic, manufactured, or even duty-free exports can be substituted against duty-paid imports if they have a qualifying HTS match. This method offers broader flexibility of claiming drawback. However, there are a few restrictions with substitution that we'll touch on later. Now that we've covered matching methods, let's talk about how they apply to common statutory filing provisions. A filing provision determines how the import and export transactions must qualify and be matched. First up, unused merchandise drawback. This provision applies when product is imported and then exported in essentially the same condition. Any incidental operations not amounting to a manufacture are allowed. There are 2 filing provisions within unused merchandise. 19 U.S.C. 1313 J1, known as unused direct identification, and 19 U.S.C. 1313 J2, known as unused substitution. Under J1, duty-paid imports are matched to exports of the same part, SKU, or material number. This requires lot or serial number tracing. If that isn't available, then utilizing a drawback accounting method. Under J2, duty-paid imports are matched to qualifying exports that share the same 8 or 10-digit classification. With unused substitution, the origin of the export does not matter. In other words, imported duty-paid product can be substituted against domestically sourced exports if they share the same qualifying HTS. Now on to manufacturing drawback. This applies when duty-paid components or raw materials are used to produce finished goods that are then exported. There are 2 filing provisions within manufacturing drawback. 19 U.S.C. 1313A, known as manufacturing direct identification, and 19 U.S.C. 1313B, known as manufacturing substitution. Under A, components or raw material part numbers used in the production of a finished good are traced with lot or serial numbers through the bill of materials back to their importation. Under B, components or raw materials are substituted at the HTS level within the bill of materials. If a company dual sources components or raw materials, whether domestic, duty-free, or duty-paid, they can be substituted if they share the same 8 or 10-digit HTS. Because of this, it's important to classify all of your components or raw materials accurately. We've covered common drawback filing provisions and matching methods. Now, let's go over a few important rules and restrictions. First, there's the other classification restriction. If an 8-digit HTS description begins with other, it's considered too broad for unused substitution. If the 10-digit classification also begins with other, then unused substitution is not allowed. In that case, we must file under unused direct identification. There's also an export destination restriction under USMCA and Chile FTA. If a duty-paid import is exported to Canada, Mexico, Chile, or any U.S. territory, we cannot use unused substitution. In these cases, we again have to file under unused direct identification. Now let's cover a few common rules. The first is called lesser of two values, which applies to unused substitution. When substituting merchandise, you can only claim drawback on the lesser of the import or export value. For example, if you import a duty-paid item valued at $100 and export a substitute valued at $50, you would only receive drawback on the $50 value. It's important to substitute similar value exports. Otherwise, you can leave significant recovery opportunity on the table. The second rule is called lesser of two duties, which applies to manufacturing drawback. This affects finished goods exported to Canada, Mexico, or Chile. If the finished good exported enters the country duty-free, then the lesser of two duties between the duty-paid import and the finished good is 0. This rule largely limits manufacturing drawback eligibility when exporting to those countries. Lastly, there's a rule called first filed. If a claimant designates an import entry line number under a specific provision, any remaining balance of that entry line must be filed under the same provision. In other words, you cannot mix provisions within an entry line number. Let's take a break from the regulatory framework of drawback and discuss the operational processes required to compliantly file and support a drawback claim with customs. We like to break this down into two main elements: data and documentation. The data used to prepare and file a drawback claim comes from several sources and depends on the filing provision being used. For imports, your first source is ACE, which stands for Automated Commercial Environment, and it's used for all provisions. Access to this online portal, hosted by Customs, is free of charge and provides import reporting for your EIN. When filing under a provision with direct identification, part-level detail is required. Your broker might have this reporting, but more often, commercial invoices from import entries need to be keyed to build this database. For exports, reporting comes from your company's ERP system, and there are specific data field requirements that must be met. When filing manufacturing drawback, the bill of material also comes from your ERP system and has specific data requirements. It's important to note that all data gathered or captured should undergo an extensive data validation procedure for accuracy and compliance. Now, on to documentation. Documentation is not submitted every time a claim is filed, but it is needed to support your program's compliance with customs. For import documentation, your broker will retain the CF 7501 entry packet. For export documentation, your freight forwarder or broker will retain the bill of lading and supporting records. On the bill of lading, your company must appear as the shipper, designating you as the exporter of record. In the event of a desk review or audit of your claims from customs, your ERP system will be used to generate inventory receipt and withdrawal records. Keep in mind, all documentation must be retained for up to 3 years from the date of liquidation of your drawback claims. Now that you have a solid understanding of drawback, you might be wondering, how do I get started? Here's a high-level overview of the process. First, you'll want to apply for ACE access with customs. It's free and provides import and export reporting tied to your company's EIN. Next, have a drawback service provider conduct a recovery assessment. This step serves two important purposes. First, it helps you build your internal business case by showing what's actually recoverable. Second, it gives you the chance to evaluate how well your service provider performs in a real-world test of your data. Duty drawback is a highly dynamic environment with multiple provisions and numerous matching possibilities, and the outcomes can vary significantly between service providers. The assessment also enables your service provider to propose an appropriate fee structure, typically a contingent percentage based on the recovery they project and ultimately deliver. Before you can begin filing claims, you'll need to submit your drawback privilege applications to customs. These filing privileges streamline the drawback process. In most cases, your service provider will handle these submissions for you. On average, this one-time process typically takes 120 days to secure approval from customs. If you're filing manufacturing drawback, you'll also need either a manufacturing drawback ruling approved by customs before submitting your privilege applications. Lastly, once your privilege approvals are in place and data and documentation have been gathered and validated, your broker can begin preparing and submitting claims. Filing under accelerated payment privilege, the claimant will need to secure a drawback-specific customs bond, and you can expect to receive refunds in roughly 30 days from the date each claim is filed. I want to thank you for joining me today. Duty drawback can be nuanced and complex, but I hope today's session gave you a clear picture of the opportunities it can create for your organization. Whether you're new to drawback or have an existing program, if you have questions or want to explore how to maximize your company's recovery, don't hesitate to reach out to a duty drawback expert at Drawback Services. We're here to help.